Welcome back to the Deep Dive. So glad you're joining us.
Great to be here.
Today we're diving deep into, well, a really fundamental part of how businesses are set up, especially, as they get bigger.
Mm-hmm.
We're jumping into Unit 1 of IGCSE Business, and specifically Part 3, which covers the different forms of business ownership.
That's right. And our focus today is Chapter 4, Limited Companies and Multinationals.
Okay, limited companies and multinationals.
And really, think of this chapter as like a crucial building block. It's foundational for understanding business properly, not just for IGCSEs, but, in general.
Yeah, I get that. Grasping this stuff is pretty essential, right? Because these limited companies, they're everywhere.
Absolutely everywhere. From medium-sized local businesses right up to those huge global corporations we all know about.
And you mentioned IGCSEs. It's particularly key for the exam, isn't it? Especially when you hit those case studies.
Definitely. The exam, it often splits,
Yeah.
Paper 1 tends to be about smaller businesses.
Right.
And Paper 2 often looks at the bigger ones. So knowing these different ownership forms, especially the differences we'll talk about today, it really helps you immediately get a grip on the key features, the implications in any case study they throw at you.
Ah, okay. So it tells you things like who owns it, where the money's coming from.
Exactly. And who's on the hook if things go south. It sets the scene.
Got it. So what's our mission for this deep dive then? What are the core things we want you, the listener, to really get a handle on from this chapter?
Okay, the main goal is to really understand the big differences between limited companies and the other forms you might have already looked at, like sole traders or partnerships.
Right.
The source material really hammers home the idea of limited liability. That's a massive, massive difference. And also, the specific legal documents you actually need to form one.
Okay, limited liability and the paperwork, the formal process.
Yeah, the legal side is key. And the chapter also splits limited companies into two main types, doesn't it?
It does.
So we'll spend a good chunk of time looking at the difference between private limited companies, PVT, LTD, and public limited companies, PLCs. They share some basic ideas, but how they differ. Well, it has huge implications for how they run and how big they can get.
Okay, private versus public. Got it. Now, quick point, the chapter title mentions multinationals, those giant companies operating everywhere. Are we tackling those today?
Good question. Not today, no. Multinationals are, well, there's such a huge topic in themselves.
Yeah.
That the source material actually saves the detailed look at their features for a bit later. It's covered in Part 4, which is all about globalization and multinational companies.
Oh.
So we'll dedicate a whole separate deep dive just for that. It's a fascinating area, but needs its own space.
Perfect. Keeps things focused. So today, strictly limited companies, what they are, how you set one up, and those key differences, private versus public.
Exactly. And our purpose is really to help you study and revise the core ideas in this part of the unit based only on the material provided in the chapter. We're focusing on the titles, the subtitles, those bold blue ones, and the bullet points.
Right, sticking to the source text.
Yeah. We're not going through the specific activities or case study questions right now, but we will definitely pull examples from those case studies mentioned just to illustrate the points we're making, make them a bit more real.
Good idea. Makes it less abstract.
Precisely. And we're keeping in mind, that you might be an IGCSE business student, maybe English isn't your first language, so we'll aim for real clarity, break things down step by step.
Couldn't ask for a better approach. Right then, let's dive in.
Yeah.
Where do we start with understanding what a limited company actually is?
Okay, let's unpack it. Based on the material, the absolute core concept, the thing that makes them fundamentally different from, say, a sole trader, is that limited companies have a separate legal identity from their owners.
Separate legal identity. Okay, sounds a bit formal. What does that actually mean in practice? For the business, for the owners?
Think of it like this. Once you form a limited company, the law basically treats it as its own person, separate, distinct from the people who started it or own shares in it.
Like a legal person.
Exactly, a legal person. And this person can do things in its own name. For instance, the company itself, not the owners, can own assets, buildings, vans, machines, patents.
Okay.
It can sign contracts, agreements with suppliers, customers, banks, all in the company's name.
Right.
It can employ people directly. The employment contract is with the company. And this is critical because it's a separate legal entity. It can sue other people or companies in court. And just as importantly, other people can sue the company in court.
Ah, so they sue the company, not the owners personally.
That's the crux of it. It exists and acts in the legal and business world all on its own.
Wow, okay. That's a huge difference from being a sole trader where you are the business legally.
It's massive. And the separation, the separate legal identity, it leads straight to the most significant feature, the one the source highlights again and again, limited liability.
Okay, limited liability. You said this is where it gets really interesting.
It is. And it's probably the number one reason people choose this structure.
So explain limited liability. What does it mean for the people putting money into the company, the owners?
Okay. Limited liability means that the owners, and remember, in a limited company, we call the owners shareholders.
Shareholders.
Their responsibility for the company's debts or losses is limited. It's capped. It only goes up to the amount of money they have actually invested in the company by buying shares. That's it.
So only the money they put in is at risk.
Precisely. Their liability is limited to their investment.
So let's say the company borrows a load of money, owes suppliers, but then the business fails. It can't pay its debts. The bank, the suppliers, they can only go after the company's assets.
Exactly right. They can claim against what the company owns. But, and here's the really key part for the shareholders, their personal assets.
Like their house, car.
Yes, their house, their car, their personal savings account. Anything that wasn't put into the company are protected. They're completely separate. Creditors cannot touch those personal assets to pay off the company's debts.
Wow. That is a huge difference compared to a sole trader or maybe a partnership where owners have unlimited liability. Yeah, their personal wealth is totally on the line there.
Totally. With unlimited liability, if the business debts are more than the business assets, the owners have to cough up their personal money, sell their personal things to cover the difference. Limited liability takes away that huge personal risk beyond what you chose to invest.
Which must make investing seem a lot safer.
It does. It makes people much more willing to put money into businesses, which is obviously vital for the economy for growth.
Okay, so that's the liability sorted. What about the ownership structure? You mentioned shareholders.
Right. So limited companies are owned by shareholders. These are the people, or sometimes other companies, who provide the money, the capital that the business needs. In return, they get shares.
And shares represent a piece of the ownership.
Exactly, a slice of the ownership pie.
Yeah.
So shareholders are effectively the joint owners of the company.
And what do these shareholders actually get to do? What rights do they have?
Well, as owners, they have certain important rights. They get to vote on big decisions about the company's direction, major strategic moves. And crucially, they vote on who runs the company day to day.
The managers.
The directors, yes. They also have a potential financial reward if the company makes a profit.
Yeah.
The shareholders might get a share of that profit.
Yeah.
This payout is called a dividend. It's usually paid out maybe once or twice a year, but only if the company is profitable and the directors decide it's best to distribute some profit rather than, say, reinvesting it all back into the business.
Okay, so shareholders own it, go on big things, get dividends maybe, but they're not necessarily running the show day to day.
Generally, no, especially in larger companies. That's where you see this separation of ownership and control. The shareholders elect a board of directors.
Right, the directors.
These directors are the ones responsible for the actual management, the day-to-day running, making operational decisions, implementing strategy.
So the directors answer to the owners, the shareholders?
Precisely. They're appointed by the shareholders, and they are accountable to the shareholders.
Yeah.
The source mentions the chairperson leads the company and is accountable to shareholders. Big decisions like approving the annual accounts, electing directors, major policy changes, these are often formally voted on at the annual general meeting, or AGM.
AGM.
Yeah, it's a yearly meeting, and all shareholders have a legal right to attend and vote.
That whole structure, owners, directors, AGMs, it sounds much more formal than just a sole trader making all the calls. What about tax? Is that different too?
It is. Limited companies are taxed differently. The company itself pays company tax, often called corporation tax, on its profits before any dividends are paid out. That's different from sole traders or partners. They typically pay personal income tax on the profits their business makes, as if it's their own income.
Right. And finally, setting one up. It's not like just putting up a sign and starting to sell stuff, is it? There are legal hoops to jump through.
Definitely not. To form a limited company, you have to follow a formal legal procedure. You can't just declare yourself a limited company. There are specific steps, requirements, and paperwork involved. You need official permission, basically.
Okay, so let's get into that legal procedure. What does it actually involve? What's this paperwork we're talking about to set up a limited company?
Well, first off, the source says you need a minimum of 2 members to start with. So at least 2 shareholders initially.
2 people minimum. Okay.
And the really key part of the setup is preparing and sending specific legally required documents to the Registrar of Companies.
The Registrar of Companies,
Yeah.
like a government office.
Exactly. It's the official body in the UK. It's often called Companies House that handles the registration of companies, keeps records, and so on. You have to get these documents approved by them before the business can legally start trading as a limited company.
Okay, the essential paperwork. The source highlights two really critical documents, doesn't it? The foundation stones.
It does. The two most important ones mentioned are the Memorandum of Association and the Articles of Association. Think of them as the company's founding constitutional documents.
Right. Let's break down the Memorandum of Association first. What's its job? What info does it have?
Okay, the memorandum is kind of like the company's external-facing charter or constitution. It defines its basic structure, its purpose, how it relates to the outside world legally. The source lists the key things it must contain. First, the name of the company. Obviously needs to be unique, checked, and registered.
Makes sense.
Second, the name and address of the company's registered office. This is its official legal address for all correspondence, legal notices. Doesn't have to be where it actually trades from, but it has to be a real address.
Okay.
Third, the objectives of the company and the nature of its activities. Basically, what is this company being set up to do? Is it making things, selling things, providing services? What's its business?
Its purpose.
Exactly. And fourth, the amount of capital to be raised and the number of shares to be issued. This outlines the initial plan for funding. How much money do they aim to raise by selling shares right at the start? And how is that total amount divided up into individual shares?
Okay, so the memorandum sounds like the big picture stuff, the company's identity, its purpose, its basic structure for the outside world. What about the Articles of Association then?
Right. The articles are different. They're the company's internal rule book. They set out how the company will actually be run, managed, administered on the inside.
Yeah.
They cover the rights and duties of the shareholders and the directors.
So internal rules, like what specifically?
The source gives examples like the rights of shareholders, especially if there are different types of shares. Some shares might get more votes than others, or different rights to dividends. The articles spell this out. The procedures for appointing directors. How do people get onto the board? How are they elected, maybe at the AGM? How can they be removed?
Right.
The length of time directors should serve before they need to be reelected. Setting their terms. A timing and frequency of company meetings. Like how often does the board meet? What are the rules for calling an AGM?
Got it.
And, really importantly, the arrangements for auditing company accounts. How will the company's financial records be checked independently by outside auditors to make sure they're accurate and follow the rules?
Okay, so memorandum for the outside world, articles for the internal rule.
You've got it. They work together. And once these docs are prepared properly, submitted to the registrar, and the registrar is happy,
Then what?
then they issue the single most important document for a new limited company, the Certificate of Incorporation.
The Certificate of Incorporation. And that's the magic moment. The company officially exists.
That's it. It's the formal legal proof that the company has been registered. It exists as a separate legal entity. It's like the company's official birth certificate. Once you have that certificate, the company is legally allowed to start trading.
And the source mentions some ongoing things too, even after you're set up.
Yeah, there are ongoing rules. The company has to keep a formal register of shareholders who owns what. And, like we said about AGMs, shareholders must get written notice about the date and location for the annual general meeting. It's all quite regulated.
Okay, that covers the basics and the formation process. Now let's get into those two distinct types the chapter talks about, starting with private limited companies, PVT Ltd.
Right, private limited companies. What the source immediately points out is their typical size. Most tend to be small or medium sized. They're usually not those massive household names, although some can definitely grow quite large over time.
And you can often tell by the name, can't you?
Yeah, that's a good clue. Their company name nearly always ends in limited or Ltd in places like the UK. The source mentions other endings for different countries too, like GmbH in Germany, but the idea is the same. It signals limited liability and private status.
Now, the absolutely crucial thing, the big difference compared to a public one, is how they handle their shares, right?
This is the absolute key differentiator. In a private limited company, their shares can only be transferred privately. They are not for sale to the general public on any kind of open market.
Okay, transferred privately. What does that look like in reality? How does it work?
It means if a shareholder wants to sell their shares, or if the company wants to issue new ones, They have to find buyers privately, often through personal contacts, existing shareholders, maybe specific private investors. You can't just log onto a website and buy them. And often, the Articles of Association, that internal rule book, will have rules about this. Like, existing shareholders might get the first chance to buy any shares being sold.
Right.
Or maybe the directors or even all the other shareholders have to approve the transfer before it can happen.
So it can be quite difficult to sell your shares.
It can be, yes. It makes selling shares much slower and potentially harder compared to other structures.
And just to be crystal clear, they cannot be sold on a stock exchange.
Absolutely not. That's the defining line. Shares in private limited companies cannot be traded on the stock market, like the London Stock Exchange or New York Stock Exchange. No way. This really limits who can invest.
So given those rules, who usually owns these companies?
Well, because it's all private transfers and often needs agreement, they very often end up being family businesses. Or they're owned by a fairly small group of close friends or business associates. Ownership tends to be concentrated, not spread widely.
And does the management usually reflect that close ownership?
Yeah, generally it does. The directors in a private limited company are often shareholders themselves. They tend to be very involved in the actual day-to-day running of the business. There's usually less of a gap between the owners and the people managing it compared to huge public companies.
The source gives that example, Con Sugar Mills.
Yeah, Con Sugar Mill is a really good illustration. The case study says it started as a family business, then became a private limited company. And it mentions they got funding from a venture capitalist firm called FarmVent.
A venture capitalist. What's that exactly?
Right. A venture capitalist firm, or VC, is basically a company that invests money, often quite a lot, into businesses, usually newer or growing ones, that they think have high potential. In return, they take shares, so they become part owners, and they often get involved in advising or guiding the business too.
Okay, so they're private investors.
Exactly. And if you look at the pie chart in the source for Khan Sugar Mills' ownership, it shows it's split between family members, Abdul Khan, Mohsin Khan, Nabi Khan, some senior managers who work there, and FarmVent, the VC firm.
I see.
So that shows perfectly how a private limited company's owners can be a mixed family, key insiders, private investors, but it's still a defined limited group, not the general public.
And that other example, HK Kak Hong Office Supplies, fits too. Lee Kwok Hung started as a sole trader, then went private limited, bringing in family and friends as shareholders to get money for expansion.
It does. It shows that typical journey. He needed more cash than he had alone, so he used the private limited structure to bring in a specific group of private investors he knew as family and friends.
Okay, that makes the structure and ownership clear. Now let's connect it to the big picture. What are the practical pros and cons of this private limited structure? Why choose this?
Right, let's look at the advantages and disadvantages of the source list. We'll start with the advantages, benefits.
First one has to be limited liability again, yeah?
Number one, definitely. Limited liability for shareholders. We've covered what it means personal assets are safe. But why is it such a benefit? It just massively cuts down the personal financial risk. You know exactly what you stand to lose, just your investment. This encourages people to actually invest, start companies, take calculated risks, which is good for everyone.
And that protection probably helps with the next advantage, getting more money.
It feeds right into it. Because you can offer limited liability, it's easier to get people to invest. So, more capital can be raised compared to being a sole trader or just a partnership. A sole trader uses their own cash or personal loans. A partnership pools money from just a few partners. But a private limited company can sell shares to multiple people, family, friends, maybe even VCs like FarmVent. You can gather a much bigger pot of money.
And why is that extra capital so good?
Well, more money means you can do more. Invest in better equipment, expand your factory or office, hire more skilled people, run bigger marketing campaigns, develop new products. It just allows for growth on a scale that's often impossible otherwise.
What about keeping control? That seems important for family businesses.
Crucial. A major advantage is that control cannot be lost to outsiders. Because shares aren't sold publicly and transfers usually need approval, the original owners, the family, the founders, can generally keep control. They decide who gets to buy in. They can stop someone they don't want from taking over.
And why is that a benefit?
It lets them stick to their original vision. They can run the business the way they think is best, maybe focusing on long-term goals or specific values, without outside shareholders pushing for, say, quick profits or a completely different strategy.
Continuity seems like another plus point, too.
Absolutely. Business continues if a shareholder dies. Remember that separate legal identity. The company isn't tied to any one owner's lifespan. If a shareholder passes away, their shares can be passed on or sold according to the rules in the articles. The company carries on.
Why is that good?
Stability. Continuity. It's much less disruptive for the business, the employees, the customers, the other owners. Unlike a sole trader, where the owner's death can mean the end of the business.
Okay. And finally, the source mentions status.
Yeah, it has more status than a sole trader. Just being formally registered, having that LTD after your name, complying with the rules, it can make the business seem more credible, more professional, more permanent to others.
Really like banks or big customers.
Exactly. Why is this a benefit? It might make it easier to get a bank loan. It might help attract better employees who want to work for a proper company. Or it could help win bigger contracts from other businesses that prefer dealing with incorporated entities.
Those are definitely strong advantages. Okay, let's flip it. What about the disadvantages, drawbacks of being a private limited company?
Okay, drawback number 1 listed is financial information has to be made public. Now, this needs a bit of context. Compared to a public company, the amount of info a private company makes public is pretty limited. But compared to a sole trader or partnership who usually file nothing publicly,
Right.
a private limited company does have to file summary accounts with the registrar of companies, and those become public record. So it's a disadvantage relative to having total privacy.
Why might that be a downside?
Well, even summary accounts give some insight. Competitors could look at them, get a rough idea of your performance or financial position. Some owners just prefer to keep everything completely private.
And setting it up isn't quick or free.
No. It costs money and takes time to set up. The legal process, drafting the memorandum and articles, paying the registration fees, it all involves costs, often legal fees, and it takes time for the registrar to process it all.
Why is that a disadvantage?
It's just a barrier. If you're a sole trader, you can pretty much just start trading tomorrow with almost no cost or paperwork. Forming a limited company takes more upfront effort and money.
How about the profits?
Ah, yes. Profits are shared between more members, shareholders. If you're a sole trader, all the profit is yours. In a partnership, you share it between a few people. In a private limited company, any dividends are shared among all the shareholders.
So your personal slice might be smaller?
Potentially, yes. The profit per owner might be less, even if the company as a whole is making more profit overall because it had more capital to grow.
And getting your money back out isn't always easy.
Exactly. It takes time to transfer shares to new owners. Because of those restrictions needing approval, finding private buyers selling your shares can be slow and sometimes difficult if you want to cash out or leave. It's not like clicking sell on a stock market app.
Why is that a disadvantage?
It makes your investment less liquid. It's harder to turn your shares back into cash quickly. And it also makes it a bit harder for the company to quickly bring in new investors if they need more funds suddenly.
And that difficulty links to the final drawback listed about raising money.
Yes, because you can't sell shares to the general public on the stock market. Private limited companies cannot raise huge amounts of money. They're limited to what they can get from their existing shareholders, or maybe finding more private investors, VCs, friends, family.
Why is that a disadvantage?
It puts a ceiling on growth, really. If a company has ambitions for massive global expansion, building huge factories, buying out major competitors, things that need billions, the private limited structure usually just can't raise that kind of money. They'd probably need to become a public company. Think back to HK Wok Hung raising HK $200 million was great for them, but that's peanuts compared to what a giant like Hyundai or Walmart needs.
That comparison of pros and cons paints a really clear picture. You can see why someone would choose it, but also its limitations. Okay, let's move to the other type. Public limited companies, PLC.
Right, PLCs. These are generally the big players, the household names you see listed on stock exchanges around the world. And their absolute defining feature, the thing that makes them public, is that their shares are freely traded and sold to the public on the stock exchange.
So literally anyone, the public, can buy shares in them, assuming they have the money and a way to trade.
Pretty much, yes. During market hours, anyone can buy or sell shares through a broker or online platform based on the current market price. Their name usually signals this too. Public Limited Company, or PLC in the UK, or similar names like AG in Germany, SA in France and Spain, SPA in Italy, as the source notes. It means public ownership is possible.
And you said they tend to be the really large companies.
Generally, yes. The source notes they tend to be large, often huge corporations, and becoming a PLC isn't easy. There's usually a minimum amount of share capital you need to have even before you can apply to list on an exchange. The source mentions £50,000 in the UK as an example, but that's just a starting point. The real hurdles are much bigger.
And the process of a company going from private to public, selling shares for the first time, there's a special name for that.
Yes, there is.
Yeah.
That whole process of selling shares to the public for the very first time to raise capital is called flotation.
Flotation. Okay.
You also often hear it called an IPO, which stands for initial public offering. Same thing.
Can you tell us a bit more about flotation? What does it involve?
Okay, flotation is a really complex, expensive, and highly regulated process. It's how a company that was previously privately owned makes the leap to offering its shares for sale to the general public on a stock exchange. It's how it goes public.
And it requires a specific document.
Yes, a crucial, very detailed, legally binding document called a prospectus.
A prospectus. What's that all about? Why is it so important?
A prospectus is basically the company's official sales pitch. It's invitation to the public to buy shares during the flotation. But because it's a legal document, it has to be incredibly thorough, accurate, and transparent.
What kind of information is in it?
Everything, really. Details about the company's history, what it does now, its financial track record, profits, losses, assets, debts, who the managers are, why they're raising the money, what they'll use it for, and critically, all the risks involved in investing in this company.
A lot of risks, too.
Absolutely. Why is it so detailed and legally required? It's all about protecting investors. It's meant to ensure that anyone thinking of buying shares has enough information, the good and the bad, to make a properly informed decision. And it makes the company legally responsible for the truthfulness of what's in there. No misleading claims allowed.
So it sounds like PLCs face a lot more scrutiny and rules than private companies.
Oh, vastly more. Public limited companies operate under extensive regulatory control. They have to follow strict rules set by government bodies like financial regulators and by the stock exchange itself where they're listed.
Like what kind of rules?
Things like very detailed and regular financial reporting requirements, strict rules on how the company is governed, corporate governance, rules about making important information public quickly. It's a lot.
The source mentioned Hyundai as an example here.
Perfect example of a PLC. Described as a huge motor company listed on the London Stock Exchange owned by shareholders, the case study talks about its massive scale, billions in sales, operating in over 200 countries. That size, that public listing, classic PLC characteristics.
Right.
Sony, too, mentioned as a huge Japanese multinational again. That scale strongly implies it's a PLC, listed somewhere like Tokyo or New York. And Walmart, called the biggest multinational, definitely a massive PLC, traded publicly.
Okay, so huge scale, public shares, lots of rules, that complex flotation process. Let's get into the advantages and disadvantages of being a PLC. What are the big wins and the big drawbacks?
It's really interesting how the pros and cons often stem directly from being public and the scale that allows. Let's do the advantages, benefits first.
I'm guessing the number one advantage is about raising money again, but even more so.
Absolutely, spot on. The single biggest advantage, the main reason companies go through the hassle of flotation, is that large amounts of capital can be raised. Selling shares on a public stock exchange opens the door to potentially millions of investors, worldwide individuals, pension funds, investment banks, everyone. You can raise staggering sums, hundreds of millions, billions, even trillions in some cases.
Wow. And why is that capability so crucial?
It just enables things on a totally different level. With that kind of money, you can fund massive projects, build huge factories, pour money into cutting-edge R&D, buy out other large companies, expand into dozens of countries at once. It gives you the financial firepower for true global-scale operations.
And the shareholders still get limited liability.
Yes, that fundamental protection is still there. Shareholders in a PLC have limited liability. Their personal finances are safe. The maximum they risk is the money they paid for their shares.
Why is that still important?
It keeps investing attractive to a really wide audience. Small individual investors, giant pension funds, they're all more willing to buy shares knowing their risk is capped. This broad appeal helps the company raise those vast amounts of capital we just talked about.
And being big brings other benefits, like efficiency.
It often does. Because they can operate on such a large scale, thanks to the capital raised, PLCs can often exploit economies of scale. This means their cost per unit of production or service can fall as they get bigger.
How does that work?
They can buy raw materials in enormous bulk, getting huge discounts. They can afford highly specialized, efficient machinery. They can spread massive fixed costs, like R&D labs or senior management salaries, over a much larger output.
And the benefit of that is?
Lower costs mean either higher profit margins for the company, or they can lower their prices to be more competitive and grab more market share. Win-win for the company, potentially.
And size can mean power in the market.
Definitely. PLCs may be able to dominate the market. With their deep pockets, huge production capacity, and often strong brand names, they can compete very aggressively. They can outspend smaller rivals on marketing, R&D, distribution. It makes it very hard for smaller firms to challenge them effectively.
Why is that dominance good for the company?
It can lead to controlling a large slice of the market, maybe even becoming the market leader. That can give them significant influence over prices and industry trends, usually leading to higher, more stable profits.
For the investors, being able to sell shares easily must be a big plus.
Huge advantage, yes, for both investors and the company. Shares can be bought and sold very easily on the stock exchange. Unlike private shares, which can take ages to sell, you can usually buy or sell PLC shares in seconds or minutes during trading hours.
And why is that liquidity so beneficial?
For investors, it means they can get their cash back quickly if they need it or want to invest elsewhere. For the company, the fact that shares are easy to trade makes them more attractive to investors in the first place. This makes it easier for the company to raise more capital later if needed, say by issuing new shares, because investors know they won't be stuck with the shares.
And finally, just being well known, that high profile.
Right. A PLC may have a very high public profile. Being listed on a major exchange, often being a large company with recognizable brands, it brings a lot of public awareness.
And the benefit there?
It's like free advertising. It boosts brand recognition, can attract customers globally. It also really helps with recruitment docils. Talented managers and employees often prefer the perceived prestige and stability of working for a well-known PLC.
Okay, that paints a compelling picture of power, scale, and access to funds. What about the downsides? The disadvantages, drawbacks of being a PLC?
Well, the flip side of all that potential often involves some significant challenges and risks. The most obvious one is just getting there in the first place. Setting up costs can be very expensive. That flotation process we talked about, it's incredibly complex and costs a fortune. You're paying investment bankers huge fees to manage the share sale, lawyers for all the legal work, accountants for audits, plus massive marketing costs to promote the IPO.
Why is that a disadvantage?
It's a huge barrier to entry. Only companies that are already pretty large and successful can even afford to consider going public. It's just not feasible for smaller businesses.
And unlike a private company, you mentioned you can actually lose control.
Yes, this is a major, major risk. Outsiders can take control by buying shares. Because anyone can buy shares on the open market. If another company, or even a wealthy individual or group, buys up enough shares, usually more than 50% of the voting shares, they gain control.
A takeover.
Exactly. A hostile takeover is possible. The new majority owner can then kick out the old board of directors, install their own people, and completely change the company's strategy or direction, even break it up.
Why is that a disadvantage?
The original founders, the existing management, long-term shareholders, they can lose control of the company they built or invested in, potentially against their will.
That required transparency sounds like it could be a drawback, too.
It can be. More financial information has to be made public. PLCs have to publish far more detailed financial data than private companies. Full annual reports, usually quarterly updates, loads of info in prospectuses and filings.
And the downside of that is?
Competitors get a really good look at your inner workings. They can see your revenues, your costs, your profit margins, your debts, where you're investing. While transparency is good for investors and accountability, giving away that much sensitive info can definitely hurt your competitive position.
And all those rules and regulations you mentioned.
A significant burden. There is more regulatory control. PLCs have to navigate a complex maze of rules from government regulators and the stock exchange. Compliance is mandatory and involves stringent reporting, governance rules, timely disclosures of anything important like profit warnings or big deals, endless audits.
Why is that a disadvantage?
It adds layers of complexity, cost, and bureaucracy. You need big legal and compliance teams, external auditors. It's expensive. And all these rules can sometimes slow down decision-making or limit management's flexibility to act quickly.
Okay, and finally, that potential gap between the owners and the managers.
Yes, the issue where managers may control rather than owners, shareholders. In a giant PLC, ownership might be spread across millions of shareholders worldwide. Unless you own a huge block of shares, your individual influence as a shareholder is tiny.
So the directors and managers run the show?
Pretty much. The day-to-day and even strategic decisions are made by the board and senior execs. They might be highly paid professionals, but they might own very few shares themselves or none at all.
And why is that separation a potential disadvantage?
It can lead to what's called the principal-agent problem.
Yeah.
The interests of the managers, the agents, might not always align perfectly with the interests of the shareholders, the principals. Managers might prioritize things like growing the company size, which often increases their pay and prestige, or job security or empire building, rather than maximizing shareholder value through profits and share price growth, which is what most owners want. Shareholders might disagree with management, but find it very hard to actually influence them or make changes.
That's a really thorough breakdown. The differences are stark. Okay, let's just quickly recap those key distinctions between private and public limited companies, just to lock them in.
Good idea.
Yeah.
Pulling it all together from the source material, the main differences boil down to share trading. This is the big one. Private shares, private transfer, restricted, not on stock exchange. Public shares freely traded on stock exchange by anyone.
Right.
Size, private, usually small, medium. Public tend to be large, massive. Raising capital. Private, limited sources, private investors. Public can raise vast sums from the public market via flotation IPOs.
Huge difference there.
Financial information. Private, limited info made public, summary accounts. Public, extensive, detailed financial info must be published regularly.
Transparency levels.
Regulation. Private, less regulation. Public, much more regulatory control and compliance burden.
Got it.
Control. Private usually stays with founder's family due to share restrictions. Public risk of losing control to outsiders via takeovers, potential separation of ownership and management control.
Okay.
Setup. Private, less expensive and quicker to set up. Public flotation process is very complex, time-consuming, and costly.
That summary nails it. Really shows how fundamentally different they operate. Even though they both offer limited liability, the choice has massive implications.
It's one of the most critical strategic decisions a growing business faces.
All right, let's do a quick check then, based on everything we've just covered. Just a few questions to see if these ideas are sticking.
Okay, let's test that understanding. Question 1. Which specific legal document confirms a limited company is officially registered and has permission to trade? Is it the Memorandum of Association, Articles of Association, Certificate of Incorporation, or the Prospectus?
The one that confirms it exists legally.
Question 2. Which piece of information is typically found in the Memorandum of Association, focusing on the company's external identity rather than the internal rules found in the Articles of Association? Is it procedures for appointing directors, timing of company meetings, the name of the company, or rights of shareholders?
Okay, think external basics versus internal rules.
Question 3. What is the specific term for the process when a company sells its shares to the general public for the first time to raise capital? Is it incorporation, flotation, auditing, or dividend payment?
That going public process.
And question 4. Which of these is generally considered a key disadvantage of being a public limited company compared to a private one? Is it A, shareholders have unlimited liability? B, it is difficult to sell shares quickly? C, there is a risk of control being lost to outsiders? Or D, profits are shared between more members?
Okay, think about the downsides specifically for a PLC. Take a moment to think about those. They really hit the core points from the chapter material we've discussed.
Yeah, they cover the key documents, processes, and those crucial comparisons.
Which brings us neatly to our final provocative thought for today's deep dive. We've talked a lot about limited liability, how it shields owners' personal assets.
Right. So here's something to chew on. Given that protection, where the owners know their personal house or savings aren't directly at risk from the company's debts, does this structure maybe, just maybe, encourage businesses, especially those big PLCs with dispersed ownership, to take on more risk than they might otherwise?
That's a really interesting point. If the personal downside is capped at just your investment, are you potentially more willing to gamble with the company's money? Maybe borrow more heavily, pursue riskier strategies, hoping for a bigger payoff.
It raises that fundamental question about the balance limited liability creates. On one side, it's undeniably powerful in encouraging investment and business formation, driving economic activity. But on the other side, does it shift too much risk away from the owners and onto others, like the company's lenders, its suppliers, even its employees, if things go wrong and the company folds?
It's a core feature of how modern business works, but it definitely has implications worth thinking about beyond the textbook definition.
Exactly. Food for thought.
Definitely. Well, we've covered a huge amount today. We've really dug into what limited companies are, exploring that idea of separate legal identity, and the absolutely crucial concept of limited liability.
And we walked through the formal steps for setting one up, the key documents like the memorandum and articles of association, and getting that all-important certificate of incorporation.
Then we broke down the two main types, private limited companies and public limited companies. We looked at their unique features, used examples from the source material like Con Sugar Mills and Hyundai.
Yeah, and we did a pretty detailed comparison of their advantages and disadvantages, hopefully helping you understand the real-world trade-offs involved in choosing one structure over the other.
And just a reminder, this deep dive was squarely focused on the limited companies part of Chapter 4, which sits in Part 3 of Unit 1.
That's right. The topic of multinationals, even though it's in the chapter title, is a big subject on its own. As the source indicates, we'll tackle that properly in a future deep dive when we look at Part 4, Globalization and Multinational Companies.
So we really hope this session has been useful for your studies, for your revision, giving you some clarity and context on this really essential part of the IGCSE business course.
Absolutely. Understanding these structures is key.
And if you are looking for more resources, perhaps revision notes, quizzes, or other materials related to this topic or other areas of IGCSE business.
Don't forget you can find helpful resources by visiting www.igces-business.weebly.com.
That's www.igcse-business.weebly.com.
We hope this has helped, and best of luck with your continued learning.
Thanks so much for joining us for this deep dive.